Welcome to the Department of Distance and Continuing Education, University of Delhi. Masters of Business Administration MBA Semester 1 Core Course MBA FT 6104 Accounting for Managers. Lesson 2 Preparation of Financial Statements Corporate Balance Sheet. 2.1 Learning Objectives. The objective of this lesson is to explain students with the mechanics and ways of preparing financial statements of a company. This lesson will familiarize students with the basic terminologies, methods, accounting standards, Indian accounting standards. After preparation of financial statement, this lesson will help the student to analyze it under different conditions. 2.2 Introduction. A financial statement is a collection of all the financial information of a business. It provides information about financial position and performance of an organization. While analyzing and interpreting the financial statement of a company, one can make important decisions and draw conclusions about financial health of an organization. Assets, liabilities, and equity are the key components associated with the measurement of financial position. However, to assess the financial performance of the business, revenue and expenses are taken as essential element. 2.2.1 Maintenance of Books of Account. Under Section 128 of the Companies Act 2013, every single company should prepare and place all financial statements and other relevant books, papers of the company for financial year at its registered office and its branches, if any, on accrual basis and double entry accounting system. These financial statements should present a true and fair picture of the financial position and performance of the company during the accounting period. 2.3 Meaning and components of financial statements. As per section 129 of the Companies Act 2013, the directors of the company should lay financial statements at the annual general meeting of the company. The financial statement under section 2 clause 40 of the Companies Act 2013 includes the following. First, balance sheet, which reports the financial position of a business at a certain point in time. Profit and loss account or income expenditure account shows the financial performance throughout the time frame. Cash flow statement encapsulates the total cash inflow and outflow for the period from operating, investing and financing activities. Statement of changes in equity summarizes how equity in the organization, if applicable. Along with the statements mentioned above, it is necessary to give explanatory notes in the annexure for better understanding. There is an exception for mandatory requirement for making cash flow statement of one-person company, dormant company and small companies. Financial statements include statements of profit and loss account, balance sheet, cash flow statement, statement of changes in equity, if required, notes and other statements. 2.3.1 Provisions applicable. While preparing final accounts of the company, the following points should be kept in mind. As per Schedule 3 of the Companies Act, all necessary requirements, other statutory requirements, accounting standards by MCA from Accounting Standard 1 to Accounting Standard 29, statement and guidance notes issued by ICAI for understanding the rules related to accounting treatments, valuation, disclosure for the following companies. If any specific act is applicable, example for an insurance company, banking company, company working in generation of electricity or any other company prescribed under Act for which a form of balance sheet and profit and loss account has been prescribed. All other companies. As per Section 2, Clause 41 of the Companies Act 2013, the financial year for making financial statements should end on 31st March. Activity 1. Go to the official website of the following companies and download the statement of profit and loss and balance sheet of the companies and check the format of each document downloaded. Bharat Heavy Electricals Limited, Reliance Limited, Infosys Limited and HDFC Bank Limited. 2.4. Users of financial statements. The financial statements provide financial position, performance and cash flows of the organization, which is helpful for various stakeholders such as investors, employees, lenders, suppliers, creditors, customers, government and general public. The stakeholders mentioned above uses these summarized as per their requirement. There are various categories of stakeholders or users of financial information which are interested in determining the financial position and financial performance of the business. Internal users includes owners, proprietors, shareholders. They need information relating to return on investment, net profit, financial position of the company or business or growth rate. Management, they need information with respect to rate of return from different segments, products and investments. Employees, they need information with respect to profitability of their employer to bargain wage rates and bonus, dues including PF, ESI, etc. are being deposited regularly. External users include potential investors. They need information with respect to business and financial risk, EPS, future prospects of the business. Creditors and suppliers, they need information with respect to short-term liquidity, including creditors are interested in knowing financial capability and ability of the business to pay its debt on time. Lenders, they need information with respect to repaying capacity, creditworthiness, short-term liquidity and long-term solvency. Tax authorities, they are concerned with assessment of income and expenses, tax dues, true and fair disclosure of accounting information. Others, including customers, researchers, seek different information for different owned, customized interest and reasons. 2.5. Presentation of financial statements. MCA has laid down the roadmap for all companies except banking companies, non-banking finance companies and insurance companies for option of Ind AS on February 2015. Under presentation of financial statement Companies Act revised 2016, IFRS converge with Indian accounting standards Ind AS from financial year 2016-17 is mandatory, where the Finance Ministry has taken various steps to simplify the implementation of Ind AS. Ind AS 1 provides appropriate guidelines related to presentation of financial statements. The basic purpose is to ensure compatibility of the business entity with its previous year's performance and with the other business entities. Structure of Ind AS Schedule 3. A. General instructions for preparation of company's financial statements. B. Part 1. Preparation of balance sheet and statement of changes in equity, if any. C. Part 1. Notes and general instructions related to point number B. D. Part 2. Form of statement of profit and loss account. E. Part 2 notes general instructions for point number D. F. Part 3 general instruction for preparation of consolidated financial statements. In text questions. Number 1. Under section 128 of the Companies Act, the financial statements of the company should capped in. Number 2. Which of the following is not a part of financial statements under section 2 clause 40 of the Companies Act 2013? Statement of profit and loss account, balance sheet, cash book, cash flow statement. Government and regulators uses the financial statements of various companies to check its governance and tax related matters, true or false. 2.6 Statement of profit and loss. The statement of profit and loss reports the financial performance of the business during a specific period, taking revenue and expenses as a key variable, usually for a fiscal year or a quarter. There are three major types of profits in an organization based on specific information: gross profit, operating profit, and net profit. Gross profit determines the business efficiency and talks about the profit margin of the business. Operating profit is the net income of an organization derived from its core operating activities. Net profit is representation of the amount company takes for itself. The main objective of profit and loss account are as follows. First, profit and loss account is helpful in knowing the trading results, that is gross profit or gross loss, and net profit or net loss. Second, it is helpful in analyzing the relationship between profit and turnover of a business. Further, it is helpful in calculating and comparing profitability ratio of a company. Third, it helps in identification and analysis of direct and indirect expense, and also helpful in reducing the indirect expenses of the business for better performance of the business. As per part 2 of schedule 3 under section 129 clause 1 of Companies Act 2013, profit and loss account should follow the vertical format given as follows. This is the format of statement of profit and loss without stating earning before interest and tax, depreciation and amortization. First we have name of the company, then statement of profit and loss for the year ended 31st March and year. First you have to mention particulars, then next column note number. In the next column, for the year ended 31st March, current year figures in rupees. In the next column, for the year ended 31st March, previous year amounts. First heading, we have continuing operations. In that, we have revenue from operations, gross, less excise duty, revenue from operations, net. Then, other income. The sum of two is total revenue. Then we have expenses, that includes cost of material consumed, purchase of stock in trade, changes in inventories of finished goods, work in progress and stock in trade. Then we have employees benefit expense, finance cost, depreciation and amortization expense, other expenses. Then we have total expenses, then profit or loss before exceptional and extraordinary items and tax, then exceptional items, then profit or loss before extraordinary items and tax, then less extraordinary items, then we have profit or loss before tax, then we have tax expense including current tax expense for current year, less MAT credit where applicable, current tax expense relating to previous years, then net current tax expense, and then deferred tax. Then profit or loss from continuing operations, then discontinuing operations, profit or loss from discontinuing operations before tax, then gain or loss on disposal of assets, settlement of liabilities attributable to discontinuing operations. Then add or less tax expense of discontinuing operations on ordinary activities attributable to discontinuing operations. Then on gain or loss on disposal of assets or settlement of liabilities. Next we have profit or loss from discontinuing operations, then total operations, and then profit or loss for the year. Next we have earning per share of each share. It includes basic EPS from continuing operations and total operations, and also diluted earning per share from continuing operations and total operations. Then we have earning per share excluding extraordinary items per share. It includes basic EPS from continuing operations and total operations, diluted EPS from continuing operations and total operations. In text questions, under which main head of subhead of balance sheet, equity and liabilities, following items are shown? First, bills payable. Second, premium on redemption of debentures. Then sundry creditors and public deposits. Next question, give major heads and subheads shown in the balance sheet as per schedule 3 of the Companies Act 2013 of the following: bill receivable, mortgage loan, goodwill, patent rights, surplus, that is balance of statement of profit and loss account. 2.7 Balance sheet. The balance sheet of the company is a summarized statement of its financial position. It represents assets, liabilities, and other essential things of the company. The old format of balance sheet was represented in horizontal form, also known as T-shaped balance sheet. However, the method of preparation of balance sheet and its format has been revised in Companies Act 2013, and the new format is in statement form, also known as vertical format of balance sheet. The balance sheet of the company has two sections, that is the asset and the liabilities, where the former shows what a company owns and the later reports what the company owes. Financial statements report the information about entities, assets, liabilities, equity, income and expense, including loss and gain, contribution made by the owner, contribution or distributions made by owner, and his or her capacity in the business as owner. Cash flow in the organization. There is no separate format of balance sheet as per Ind AS. 2.7.1 Items necessarily required to be included in balance sheet. As per Ind AS, asset is defined as follows. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Asset includes property, plant and equipment, capital work in progress, investment property, goodwill, other intangible assets under development, biological assets other than bearer plants within the scope of Ind AS 41, agriculture. Financial assets including investment, trade receivables, loans, others to be specified, deferred tax assets, other non-current assets, current assets including inventories, financial assets, investments, trade receivables, cash and cash equivalents, bank balances other than third above, loans, others to be specified. Current tax assets, net, other current assets. As per Ind AS, equity and liabilities are defined as follows. Equity is the residual interest in the asset of the entity after deducting all its liabilities. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. 2.7.2 Current and non-current assets and liabilities distinction in balance sheet. Under Ind AS 1, an entity should make clear distinction between current and non-current assets and liabilities side of balance sheet. For classification into current items, the Ind AS focus on the following factors. The asset is expected to be realized, consumed or sold within normal operating cycle, held for the purpose of trading, expected to be realized within 12 months from the end of reporting period. The asset is cash or a cash equivalent as defined in Ind AS 7 unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. For classification of current items, the Ind AS focuses on the following factors. A liability which is expected to be settled within normal operating cycle. It is held primarily for the purpose of trading. Liability which is due to be settled within 12 months after the reporting period. It does not have an unconditional right to defer the settlement of liability for at least 12 months after the reporting period. Terms of a liability that could, at the option of the counterparty, results in its settlement by the issue of equity instrument do not affect its classification. 2.7.3 Detailed disclosure of share capital. The entity should disclose the following details about share capital either in balance sheet or in statement of changes in equity or in the notes to accounts. The number of authorized shares, number of fully paid and not fully paid issued shares, par value per shares, reconciliation of number of outstanding shares at the beginning and at end, preference shares, right shares, any restriction on distribution of dividend of such shares, shares in the entity held by the entity or by its subsidiaries or associates, and shares reserved for issue under options and contracts for sale of shares, including terms and amount. The format of balance sheet as per guidance note on Schedule 3 to the Companies Act 2013 is as follows. Part 1 Form of balance sheet. First you have to mention name of the company, then balance sheet as at year ended, amount in rupees. In the first column you have to mention the particulars, then in the next column note number, then amount of the current year, or you can say current year figures, and then in the next column previous year figures. So we are starting from the particulars, which are as follows. First, equity and liability. Under equity and liability comes shareholder funds. Under shareholder funds we have share capital, reserves and surplus, money received against share warrants. Then we have share application money pending allotment. Then we have non-current liabilities. In that we have long-term borrowings, deferred tax liabilities, net other long-term liabilities, long-term provisions. Then we have current liabilities. Under current liabilities, we have short-term borrowings, trade payables, other current liabilities, short-term provisions. Then we have the total. Next, we have assets. Under assets, we have non-current assets. Under non-current assets, we have fixed assets, tangible assets, then intangible assets, capital work in progress, intangible assets under development. Then we have fixed assets held for sale. Then we have non-current investments, deferred tax asset net, long-term loans and advances, and then other non-current assets. Then we have current assets. Under current assets, we have current investments, inventories, trade receivables, cash and cash equivalents, short-term loans and advances, other current assets. Then we have total. Now we have illustration number 1. How will you explain the following items in the balance sheet of a company? 9% debentures, proposed dividend, loose tools, capital redemption reserve. So we have the solution as follows. 9% debenture. It is a long-term debt to business, usually not secured by any collateral. 9% is the coupon rate for the long-term loan. It will come under the main head of non-current liabilities under subhead long-term borrowings. Next we have proposed dividend. The board of directors have approved the proposal of dividend to be distributed in future but not distributed yet. It will come under the major head of current liabilities and a subhead of short-term provisions. Loose tools. These are the assets used in a company for various production activities. It is helpful in conversion of raw material to finished goods. It will come under a major heading of current assets and subheading of inventories. Next we have capital redemption reserve. It is a reserve created out of profits over the years kept in company for either redemption or purchase of company's own shares. It will come under a major heading of shareholders fund under the subheading of reserves and surplus. 2.8 Cash flow statement. Cash is the blood of business. Proper circulation of blood is very important for human to survive, and in similar way proper cash circulation is very important for a business to sustain. Before we move further to understand cash flow, let's understand what is cash and cash equivalent. Cash includes cash in hand, cash at bank, demand deposits with banks, and cash equivalent means liquid investments made by the company within a maturity period less than 3 months. Cash equal to cash in hand plus cash at bank plus demand deposit at bank. Cash equivalent is equal to short-term highly liquid investment less than 3 months. Cash flow statement. It is the periodic statement showing the inflows and outflows of cash and cash equivalents from operating, investing and financing activities during a particular period, which is usually a financial year. Cash flow statement of a company exhibits the flow of incoming and outgoing cash in the business during a specific period, usually a financial year. It helps in ascertaining the ability of the business to generate cash and its utilization. It is also helpful in determining the solvency of a business. Companies Act 2013 directs all companies to prepare cash flow statement except one-person company, dormant company and small company. However, Schedule 3 of the Companies Act do not prescribe any format for a cash flow statement, and hence it should be prepared as per the Accounting Standard 3 issued by ICAI under direct or indirect method. The change in position of cash for a specific period is calculated by considering the source and application of cash and cash equivalent. Cash flow activities can be classified into inflow of cash, increase in cash, outflow of cash, decrease in cash. Sources of cash. To identify the source of cash, we have to check the inflow or increase in cash in the business. Issue of shares, equity or preference, debentures, bonds and long-term loan. Operating cash profit of the business, sale of fixed asset, sale of investments. The application of cash, we have to check whether there is outflow or decrease in the cash in the business, such as repayment of bank loan or redemption of debentures, payment of income tax, dividend, interest, operating loss of the business, cash, purchase of any fixed asset. Source of cash can be internal and external both. Internal sources usually includes cash from operations of the business. So it is important to identify operating and non-operating activities in the business. Non-operating activities are one-time event in a business which may impact on revenue but falls outside of daily routine of the business and hence excluded while calculating cash flow statements. That is loss or profit on sale of fixed asset, amortization of intangible asset. The net profit calculated by the profit and loss account will have to be adjusted for non-operating items. Also, all non-cash items, that is depreciation, creation of reserve, provision of bad debts, already considered during computation of profit and loss account will have to be adjusted for calculation of cash flow statements. 2.8.1 Classification of cash flow activities. As per Accounting Standard 3, the cash flow can be classified into three broad categories: cash flow from operating activities, investing activities and financing activities. The operating activity is the principal revenue generating activity of the business. The investing activity is a summary of acquisition and disposal of investments and fixed assets in the business, and financing activity summarizes change in the size of composition of owner's capital and borrowings in the business. A. Operating activity. Operating activities are daily activities related to producing and selling of product for generation of revenue to the business, such as sale, direct expenses, marketing expenses, etc. And it should be considered while calculating cash inflow and outflow of the business. It records both inflow and outflow of cash. The net cash flow is reported as cash flow from operating activities. Examples: cash payment made to suppliers for both goods and services, cash received from sale of goods or services, cash received from royalties, fees and other revenue. Investing activities. Investing activity is summary of acquisition and disposal of investments and fixed assets in the business. Example: cash paid for acquisition of fixed assets, investments, bonds, research and development. Cash received from sale of property, purchase of government securities, interest or dividend received from investment made, cash advances or loans given to other parties. Next we have financing activity. Financing activity summarizes change in the size of composition of owner's capital and borrowings in the business. Example: bank loan repayment, cash proceeds from issue of shares or debentures, cash payment by lessee for outstanding liabilities related to finance lease. 2.8.2 Calculation of cash flow statement. A businessman can calculate the cash flow either using direct or indirect method. Methods of making cash flow statement: direct method, indirect method. Direct method. In the direct method of cash flow statement, we calculate operating cash profit by taking all gross cash receipts and payments which are operating in nature. All non-operating and non-cash items are ignored under direct method of cash flow statement. Format for assessment of cash flow from operating activities using direct method. So it will be a table containing particulars in first column and amount in the second column. So we are covering the first column items. First we have cash receipts from cash sales, recovery of cash from debtors for credit sales, recovery of cash on account of bill receivables for credit sales, sale of scrap, less cash payments for salaries and wages, rent, electricity expense, suppliers, cash purchases, payment to suppliers, cash generated from operations, less income tax paid during the current year, cash flow before adjustment for extraordinary items, adjustments for extraordinary items. Then we have net cash utilized in or generated from operating activities. Indirect method. Under indirect method of calculation of cash flows, the net profit is taken as the base and starting point and exclude all non-operating and non-cash items. The main motive remains same using both the method, that is calculation of operating cash profit from business. Hence, non-operating items such as profit or loss on sale of fixed assets and investments, amortization of intangible assets, and all non-cash items such as depreciation, provision for taxation, provision for bad debts, transfer to general reserve, it adjusted to net profits of the business. Format for calculation of cash flow from operating activities as per indirect method. So it will be a tabular format. Now in first column we have particulars, then we have amount. We are covering the first column items. Particulars: net profit before adjustment for non-cash items, non-operating items, tax and extraordinary items. Then we have adjustment for non-cash and non-operating activities, including adding depreciation provided during the year, add loss due to foreign exchange fluctuations, add loss on sale of investments, less gain due to foreign exchange rate fluctuations, less gain on sale of investments, less dividend received, less interest received. Then we get operating profit before working capital adjustments. Now we will make adjustments for working capital changes. That includes add decrease in the amount of current asset during the year, add increase in the amount of current liabilities during the year, less increase in the amount of current assets during the year, less decrease in the amount of current liabilities during the year. Then we have cash generated from operations. Then we less interest paid, we less income tax paid, we get cash before extraordinary items. We adjust extraordinary items. Then finally we get net cash flow from operating activities. 2.9 Summary. The main objective of financial statement is to evaluate the financial position and performance of the business. As we know that a company has numerous stakeholders and it is very important to protect the interest of the stakeholders, the publication of such relevant financial statements as per guidelines of Companies Act, MCA and ICAI gives the power to these stakeholders to interpret and take decisions accordingly. A financial statement is collection of all the financial information about financial position and financial performance of an organization. The financial statement under Section 2 Clause 40 of Indian Companies Act 2013 includes the following. First, we have balance sheet, that reports the financial position of a business at a certain point in time. Profit and loss account or income and expenditure account that shows the financial performance throughout the time frame. Cash flow statement that encapsulates the total cash inflow and outflow for the period from operating, investing and financing activities. Statement of changes in equity that summarizes how equity in the organization, if applicable. Users of financial statement. In internal users, we have owners, proprietors, shareholders that focuses on return on investment, net profit, financial position of the company, business growth rate. Management that needs rate of return from different segments, products and investments. Employees are concerned about profitability of the employer to bargain wage rates and bonus, dues, PF, ESI, etc. are being deposited regularly. External users includes potential investors who are concerned with business and financial risk, EPS, future prospects of the business. Creditors or suppliers are concerned with short-term liquidity. Creditors are interested in knowing the financial capability and ability of the business to pay their debts on time. Lenders, repaying capacity, creditworthiness, short-term liquidity, and long-term solvency. Tax authorities, they are concerned with assessment of income and expenses, tax dues, true and fair disclosure of accounting information, and others, which includes customers, researchers that seek different information for their own customized interest and reasons. Financial statement of companies are to be prepared as per Schedule 3 of the Companies Act 2013. Financial statement reports the financial information about entities, assets, liabilities, equity, income and expenses, including losses and gains, contribution made by the owners, and cash flow in the organization. Statement of profit and loss. The statement of profit and loss reports the financial performance of the business during a specific period, taking revenue and expenses as key variable, usually for a fiscal quarter or a year. Balance sheet. The balance sheet of company is a summarized statement of its financial position. It represents assets, liabilities and other essential things of the company. The old format of balance sheet was represented in the horizontal form, also known as T-shaped balance sheet. However, the method of preparation of balance sheet and its format has been revised in Companies Act 2013. The new format is in statement form, also known as vertical format of balance sheet. The balance sheet of the company has two sections, the asset and the liabilities, where the former shows what a company owns and the later reports what the company owes. Cash flow statement. It is the periodic statement showing the inflows and outflows of cash and cash equivalent from operating, investing and financing activities during a particular period, which is usually a financial year. Sources of cash. To identify the sources of cash, we check the inflow or increase in cash in the business, including issue of shares, equity or preference, debentures, bonds and long-term loans. Operating cash profit of the business, sale of fixed asset, sale of investments, etc. Application of cash. To identify the use of cash, we check the outflow or decrease in cash in the business, which includes repayment of bank loan or redemption of debentures, payment of income tax, dividend, interest, operating loss of the business in cash. Classification of cash flow activities. As per AS3, the cash flow can be classified into three broad categories: cash flow from operating, investing and financing activities. Operating activities are daily activities related to producing and selling of product for generation of revenue to the business, including sales, direct expenses, marketing expenses, etc. Investing activities. Investing activity is summary of acquisition and disposal of investments and fixed assets in the business. Financing activity. Financing activity summarizes changes in the size of composition of owner's capital and borrowings in the business. Thanks for listening the lesson.